Prantik, thanks for joining me by the fireside here. You'll see I have a slight glow in the corner here to sort of reflect that kind of feeling. So I'm, obviously we've got to know each other pretty well over the last little while, and I'm fascinated to hear what you've been up to, and how you got into angel investing. So maybe let's start there. Maybe I can just ask you what your first ever angel investment was and what drew you into making that angel investment.
Yeah, firstly, thanks a lot, John, Darren, Amit, Manav, everyone for inviting me. Indeed a pleasure. Well, in terms of the first one, I think it was somewhere around July, August 2019. It was in a company called betterhalf.ai. I wasn't looking for a better half. Had lucky to have had one for a few years now. But I think what drew me into it was a couple of things actually. I think it was I'd always read about it, and I still wonder why is it called angel investing? What's so angelic about it? But I think there was, to be honest, there was a cool factor to it. It was also about 6 months post my own exit. So I had a bit of time and a bit of cash in hand, because prior to that, for the previous decade, not that we had any money, but whatever little we had went back into our own business.
Sure.
And to be honest, a lot of this happened by chance. In fact, the founder, he found me via LinkedIn, and we got connected. And yeah, that's how it started. So it was with Better Half in July, August 2019.
So I guess it's a bit early to ask you how it's going. I mean, it's only been up for a year and a bit by the sound of things. That's a tough year in 2019 to start an angel investment.
Yeah, that's true. Actually, I think specific to Better Half, if you'd asked me this 2 months ago, I think I would have had a very different answer. But I think the positive side of things, they've obviously had a difficult, not because of notwithstanding COVID. In fact, if anything, COVID would have helped them, because again, they're all about they're a match.com for Indian matrimony, right? I think what's really worked in their favor, they've really, really focused very hard on the product. And I think to their credit, they got selected in the current batch of YC. So the current batch of YC probably has the highest number of non-American companies, and probably 40 plus from India. And they were lucky to be in that. And I think I hope so. I hope that's changed the game for them, because they're close to Series A. If all goes well, in the next 6 months, they should close Series A. So things seem to be going all right for them, at least. Yeah.
That's great. And I think once you've been selected by YC, I think they've got a fantastic graduation rate there. It connects you with a lot of people you previously would not have been connected to. So as an angel, I'm sure you're absolutely thrilled to have those guys be selected.
Oh, for sure. I think it's always good to, as a founder turned investor, it's always good to see any founder do well. And it's good to see just, how they've kind of built the product, pivoted from a pure B2C to a B2C and a B2B model. It's kind of good to sit back and see and observe, and, as and when they need my help to kind of chime in. But John, what about you? I mean, obviously you've been a founder, you've had exits, you've done so many things. When and where was your first angel investment?
Well, going back some time, so for me, I've been pretty much running entrepreneurial venture-backed companies all my life. So it's hard to kind of think of the first time that I put money in a business that was completely not my own. But I would say it's probably 2009, and I put some money in a stock trading algorithm business in Australia. And
tell me, it's called Robinhood.
Yeah, exactly. I wish it was Robinhood. And fascinatingly, look, it was back then. I didn't really have a philosophy. If a friend came to me and said, "Look, I'm starting a business," I just figured, if I had some money, I would help them on their journey. I don't so much do that anymore. To me, I'm a bit more picky these days about what I personally put money into. And I find just investing because someone's a friend is probably not the wisest of business choices. So these days I'm quite a bit more picky. But back then I put some money, just $50,000 into this company in Australia, and it had great technology, but it wasn't doing very well. And about 6 months in, I actually asked to speak if I could speak with one of the customers, and I spoke with one of the customers, and he was a surgeon. And he said, look, he said, I've got my hands deep inside someone. And he said, this stock picking software, I can hear it sending me signals and alerts and things, but I can't do anything with it. And he said, I just don't have the time to basically be able to act on this stuff. And so what we later determined is it would have been better inside more of a package that, you could do in the evenings or something like that. But it was designed to be very, very timely alerts. And a lot of the customers just didn't have the time to act on those timely alerts or had a Bloomberg terminal.
Is the company around?
No, dead within 2 or 3 years.
Ouch.
And then my next angel investing was again a friend, but this has worked out much better. And that was a company called Thought River that I put a little bit of time and money into, and ended up owning 5% of the business as it started. And it's now just completed its Series A and heading towards a Series B with a fantastic bunch of VCs, including Crane, Local Globe, a whole bunch of really good UK VCs. They actually moved from here to Cambridge, here being Singapore, to Cambridge, and continued on their journey, and they're doing just fantastic. So one good, one bad. A third one which hasn't, which I don't get much communication on. And I'd have to say, if I have one big complaint about angel investing, it's that when you invest, everyone's all over you with lots of information when you first invest, and then they can be quite tardy with the follow-ups and the communication. Now, I've been guilty of that myself as someone accepting angel investing. So I won't be throwing too many stones in that thing, but that is a frustration. Do you find that Better Half are fairly good, and other companies you've invested in, are they good at reporting to you? Is the communication there, or could it be improved?
Oh, for sure, it can be improved. And I think it's a classic behavior, right? When you're looking for money, you're obviously aggressive, you're chasing. The moment the date is done, the deal's done, it's obviously a very different game. And, so I think since then, I probably have a portfolio of about 15 or 16, and I think it's a mixed bag. I think there are some who diligently, who have a structured communication where every quarter they would send some sort of an update. Doesn't have to be a revenue update, could be product, people, whatever. There are some who prefer it to be, casual WhatsApp chats. So they'll just kind of send some sort of an infographic, whatever. And there are some who have, I wouldn't say vanished. I do see their LinkedIn posts, but they don't respond on WhatsApp anymore. So I really think, in fact, I really think that there's a need for, from an investor perspective, whether it's angel or pre-IPO deals or whatever, I think a platform to manage it all, or a platform that allows people to communicate and keep, like, for example, if you ask me, I'm generally not a very organized person. So if you ask me to suddenly find the safe note that I signed with Better Half, I'll struggle. And I know there are platforms out there, but I think there could be something that just helps investors and the angels just kind of be a bit more coordinated and organized.
I think you may have recently invested in such a platform. So it's funny you mentioned
I haven't heard from that founder yet.
So it's funny you should mention that, because we're just having a debate this morning about what kind of indicators would be positive indicators for companies that don't like to report. How can you actually go out there and find publicly available signals as to their liveness or deadness, and so that's something that we're actually figuring out. We've got about 12 to 15 metrics that we're working on at the moment with PwC's help, actually, to try and figure out some more robust ways of figuring out where companies sit. So is your intention to go forward and build a large portfolio? Are you going to do this organically? Like, what's your thinking? How many companies do you think you end up investing in?
To be very honest, I haven't given it serious thought. All I knew when I started is, because obviously I had, I sought some counsel from some people who've done this before. And I think the general mantra was, build a portfolio. Don't do, hey, a friend A came in and put one and, just wait for it. So I've been lucky that I think in the last 2 years, I've got to that portfolio. And now whether I'm going to build it to 20 or 30, I don't know. But I think as a principle to me, having a portfolio with some conviction and themes, I think just gives me comfort. It could all obviously be horribly wrong. But for me, I think what's really worked is, I think the 15 to 20 number seems okay for now. But I think in terms of preference, I'm a bit more biased towards B2B, because probably I ran a B2B business myself. Obviously, technology is a common spine across these 15. And I think the application of tech is very much, at least the ones I have, is either solving a problem in the financial services domain, in the education domain, or in B2B enterprise software. There are one or two exceptions here and there, but mostly, it's B2B in these 3 or 4 domains, and mostly it's come from either Singapore or ASEAN. I mean, my background's originally born in India, grew up in Indonesia, last 20 years Singapore. So obviously the networks in these 3 countries. Of course, that doesn't limit their business operation. So I think, geographical, there is, of course, I suppose, a self-selection bias. There is a preference or a bias towards the industry one tends to believe one is familiar with. And yeah, I'm comfortable. I'm happy that it's at this stage, but it could go up a few companies more as well.
Because I think you probably, well, of course, yeah, we've done a lot of thinking around this, because when I first got into doing this, I actually ended up with a bunch of angels, and some fantastic angels in that group, actually. Trap Lewis and the Tuckerell Group, we're part of their Singapore Angel Network and whatnot. And so Javi Narola and a bunch of other guys. And so we ended up sort of just doing this organically, and that became our first fund. But what I felt uncomfortable with, that's all worked out fine. We've got a 2x, at the end of year 7, we've got 22% IRR, very happy about that. It'll eventually be a very good looking fund in year 10. But what I was unhappy about with the process was I just had a feeling that having a small number of portfolio companies was kind of dangerous, in the sense that, we did some research recently that showed that you get basically a unicorn for every 100 companies that attract outside investment. And that's a fascinating figure when you think about it, because you could be unlucky to the extent that you have a 99 company portfolio and you still miss out. We all know those stories. So our thinking is, now with Hatcher is and I don't want to go into a big sales pitch, but our thinking is the more companies that you have in a portfolio that are qualified by other people and by various other characteristics, the better chance you're going to have at those really serious power curves kicking in and taking it across the line. I'm absolutely in love with the story of Coinbase and Union Square Ventures at the moment. For anyone that's watching this that hasn't heard the story, Union Square Ventures basically took up an 8% stake in these guys at a very early stage. And that 8% stake is now worth about $8 billion, which is 40x the size of their $200 million fund. Wonderful story, but also proof of what Peter Thiel's always said, which one company can make or break your entire, or not break, but make your entire fund.
John, really... I'm going to ask you there, right? So this Coinbase story, right, or your own experience.
Yeah.
How much of it would you say is just pure luck?
A lot.
A lot.
So I was out to lunch with some guys yesterday that run a very successful firm in Singapore, and we were a very successful venture firm that everyone would know, but I won't quote them without their permission. But we're talking about this over lunch. Most VCs recognize that probability plays a huge role. So I guess the only difference is that what we're trying to do with Hatcher is we're just trying to acknowledge that probability exists, understand what the odds are, and then go to the casino at least knowing what the odds are, knowing what the time lag is, knowing how quickly or not these things pay off. And if you can understand that amount, then you can have a lot of fun. It can be less stressful than sort of just building a very small organic portfolio, because I don't know about you, but a lot of the guys that I talk to that have done 3 or 4 deals have not had a great experience, because 3 or 4 deals is just such a low level. You've got to be really lucky for one of those deals to work out well. It happens. My accountant put $50,000 into a company. 6 months later, he got a check for $400,000 in cash. So he's the worst guy to have at dinner on Friday night. You don't want that guy at dinner, because everyone else will go, "Oh, it's that easy," and we all know that it's that it's really not. So I think the probability, to your question, I think luck is hugely dependent on it, and so much can go wrong or right for founders along the way. I mean, you've had your own experience running entrepreneurial companies and now investing in 15 or 16 companies. Yeah, without naming names, can you think of a situation there where someone just got lucky, where they happened on a large customer, or are most of your guys pretty much just executing exactly to the plan that they put in front of you?
No, no. In fact, probably most of them are not executing to the plan that I saw. And I think that's, I mean, I don't mind that. In fact, that's one of the things I look out for is how wedded is the founder or the founding team to a particular idea. Because again, one could either look at it as conviction or the other. I mean, again, I love conviction. I would love to, I mean, a lot of people find founders to be arrogant, but having been one, I can understand why some may come across that, but maybe it's just a conviction, right? But I think you could have a conviction, you could choose to have a conviction, but yet be flexible, saying, hey, if this whatever conviction doesn't pan out for n number of reasons, here is path B. There's a, without naming one, there is an edtech player that I'm advising and invested in, and his original goal was to kind of provide an integrated B2B LMS, ERP, etc. to schools, tier 2, tier 3 schools in emerging markets. Fine. He's a serial entrepreneur, young guy, could come across as very, very passionate / arrogant, depends on the day. But, he's not that hasn't worked out, but he's figured lots of roadblocks, because of regulation, competition, etc. But very quickly, I think, he's figured out, and with the help of a couple of other people, that maybe there is an opportunity to kind of not really pivot, but to figure out an angle for buy now, pay later for schools, an application that really hasn't, it's been done in the US. There are a couple of players. There's one in Europe as well. But again, in this part of the world, apart from, I think, one startup, no one else is doing it. And I think the lesson there was also, I think for him, it was very humbling when he realized that the investors were not really, he's like, nah, EdTech's been there, done that. We don't want to talk about EdTech. But moment he brought in a fintech layer to EdTech, suddenly a lot of investors, oh, fintech could be just the narrative, right? Could be just the timing. But I'm not saying buzzwords is all that it takes, but I could see this in a couple of meetings. I mean, moment the VCs or the analysts heard the word BNPL and fintech, just because their mandate says so, they woke up. And it's good to see him kind of, say, okay, let me try and figure that out. I'll still sell my ERP, LMS, all of that, but maybe my investor angle is a different one. So for sure, I mean, including Happy Marketer, I mean, you think of a plan A, but there's probably plan A dash somewhere that pans out. Yeah.
So let's talk about that. So you've spent years in the advertising, marketing communications arena. Are you more comfortable with those kinds of deals, would you say? Do you gravitate towards them personally?
In fact, no, not at all. In fact, there was just one that I passed yesterday, which I think is in the domain of influencer marketing. I just think, again, it depends on the company and the specific. I think in that particular domain where I've spent about a good 15 years, there are a lot of Me Too companies, and nothing wrong with it. It's just that doesn't fit and I guess, since I've been there, done that, I also want to figure out other domains. I'm sure there are good companies there, but at least the ones that I have come across or found in this part of the world, given my selection bias, has always been, I am a dash of that. I'm a dash of Uber. I'm a Uber of dash, or, and that kind of doesn't fit well with me, at least just for me personally. So in the MarTech, AdTech space, not really. There's just a lot of, it's very, very crowded. But yeah, I think I am looking at a couple which are, again, for example, maybe a bit futuristic, but it seems to solve an interesting problem, like using OpenGPT-3. How do you do, can machines do copywriting better than humans, right? Or humans, machines may not need to do the entire copywriting, but the more streamlined email, EDMs, etc. I think that's fairly possible. So I'm really looking in that domain, really looking at things that could drive efficiency, automation. I think that would excite me. But apart from that, I think I'm not looking at anything to do with media or influencer marketing.
Yeah, as a one-time copywriter when I was 20 years old, I hope that I never have to write another ad for a lawnmower again in my life. Yeah, that's something. This is something I think people miss with AI. People see it as a threat, but really the stuff that AI is going to be good at for the next 10 or 15 years is really the drudge work. I mean, the work that no one really should be doing. I was doing a keynote at ArabNet last year, and the guy that followed me was Tim Draper, And I thought he had a wonderful way of explaining AI. He explained it in the context that basically 50% of people used to be involved in agriculture. And if you go back far enough, it's probably 95% of people, and now it's 4%. And he said, so, yes, the technology has come along and it's cleaned away a lot of jobs and whatnot, but, did people really enjoy those kind of, very, very hard, that very, very hard work? And are they now doing more productive things, having a higher quality of life? So I do think there's two sides to the coin, isn't there? Let me ask you a little bit about ticket sizes. I can tell you that the true managing partner in my angel investment thing is my wife, and I think her cutoff point is probably $100,000. I'm definitely going to have an investment committee meeting if I try and make that investment. Then I'm going to need approval. So it'll be a unanimous consent investment committee outcome that I will require to make that investment. But 25, 50, I can probably do that just as a punt. What's your situation, and where do you sort of start and stop on angel investment?
Yeah, I think if I look at it, probably my median would be around the 40, 50 mark.
Yeah.
And it's been an interesting experience, right? So like I said, when I started, the tickets were a bit higher simply because I didn't have enough deal flow and there was a bit more money. So you're like, oh, okay, I should put a bit more. But as you wisen up, as you look at more, you're like, damn. Because again, at least I've been fortunate that there's not been let's put it this way, that I think there's been a pretty healthy, steady flow of deals that have come. I think it's a challenge of being able to filter, qualify, do due diligence, because again, right, I mean, I'm not doing this full time. I still have my day job, and this is more evenings or weekends. So, and also, so it's not just capacity, capability. I mean, I honestly, I'm not really very well trained on legalese and financial analysis, right? Even having run my own business. But so yeah, I think if you ask me, the median is around that. Comfortable is that 25, and around 40, 50 is probably where I end up being. Except there have been a couple of deals early on where I was lucky enough to get into a private placement alongside a VC. And this is a fairly mature company. They're probably, at least back then, they probably valued at about 40 million. And we got in at about 30% discount. So there, the ticket size was, I think that's a one-off deal that I would have done at 250. But the rest are all around the 30, 40 mark. Yeah.
Right. Yeah.
What about you? Like, how is because obviously you've been doing this for so long. Like, has the mean or the median number really shifted over the years, depending on geography or?
Yeah, I think what's happened over the years is people have just become more transparent and open about what they do. Because I've had a couple of people, where I've been involved in a deal, and they say, "Oh, I'm really sorry, I can only do 50,000, or I can only do 100,000." I'm like, it's nothing to be sorry about. I mean, that's, and then I'll tell them that the other 8 guys in the deal are doing 50 or 100 as well. And then they go, "Oh, really?" And so what that says to me is that there's not a lot of transparency out there about what angels do. And I do think it does matter, your own experience. Like, I've noticed when I go to some angel meetings here, I'm involved with a couple of groups here in Singapore, that if a med tech company comes out and presents, all the dentists and the doctors in the room are suddenly, their eyes are glued to this guy, and that really helps. But one of the things I love about the more data-driven approach that we're taking, to talk about that for a second, is I remember I went to a demo day in Malaysia, and all the angels are in the audience, including me, and we're all sitting there with our checkbooks and our phones. And the first guy that comes out, Stanford educated Taiwanese guy, wonderful speaker, terrific presenter, did a great job. Second guy comes out, very, very similar kind of pedigree. He had a supermodel on stage with him, which I think caught the investor interest a little bit as well, at least for the men. And then the third guy came out, and the third guy was a terrible presenter, it has to be said. English was obviously not his first language. He was deeply underconfident, and his business, his slides were terrible, and he rambled on, and everyone just got on their phones and just started looking at stuff, as you do, right? And I would look up as the slides would flash every now and then. I'd look up and go, okay, there's a new slide. And I looked up, and on slide, I don't know, 16 or something, it had this graph, and it said current revenue run rate, 450,000 ringgit. Expected revenue run rate 6 months later was like 800,000. And I went, wait, yes, I put my hand up and I said, "Are these real numbers?" the guy said, oh, yes, yes. He said, actually, this chart's a bit old. We already have the 800. And I'm like, what? And suddenly we're all paying attention in the room. And so what saved this guy was one data point. And with that one data point, if that had been given to all of us ahead of time, frankly, none of the other guys would have ended up having to present, because we all just would have gone straight to this guy and offered him money. So what I found fascinating about that was the story of two presenters that were very slick and very good at the way that they presented. The third presenter who was not very good at that level of interaction, but had a cracking business. And by the way, when we got him off stage, and there was four of us just asking him questions after the presentation, he was very good and very erudite within that sort of thing. He just hated being on stage.
Yeah.
And so that was his blocking sort of thing for that. So it's just another sort of story that I keep in mind when we're looking for data. It's not always about the good looking, fantastic presenter. It's got to also be about what's behind this, because you could find a real introvert that's got, that's not very good at presenting to a set of investors. So you've got to look hard at what does the data say about this business, because they may have a patent, they may have a fantastic idea that they're executing that may not actually be coming across when they articulate it.
Would you say that at Hatcher Plus, you would kind of democratize this and just remove the whole slick pitch presentation layer? Eventually, it wouldn't matter at all.
Well, what's fascinating, isn't that an interesting thing? Because I think what's happening with the whole COVID situation is there is a lot of democratization happening. And what I really like, if there's such a thing to like about this situation, is now when we're talking with a founder, typically there's quite a lot of information flow. You're not just having a beer with someone or coffee. It's a Zoom call. You're directly into the presentation. It's very structured, and they can actually do product demos and everything without the sun glaring off their screen or them running out of power, all these other problems. So I find it actually, we're moving into a better place with respect to a lot more availability for people like you and me, for founders, because it's relatively easy to get in touch with us. And then it's relatively easy to share your story in a limited amount of time in such a way that we can say yes or no, I think, in a more efficient manner. So definitely the platform that we've built is a lot easier to do that, because of course we aggregate all this data and we create the scoring and everything. It also helps. But I just think fundamentally everything is moving towards a better place for founders, because it's just really so much easier for them to present to people like us and get the story across.
That's true. And I think even in my experience, I just love some founders who, I love it when they send me the deck in advance and I can quickly, glean through that or see the video. But I think I love it if the discussion is just centered around a demo and use cases. In fact, I remember once, one of the founders, in fact, very cleverly brought along a customer, right? Now, it could be staged, whatever, right? I don't care. But I'm just saying, at least I had the opportunity to interact with the customer and just quiz, right? And have a quick chat about, his sentiment around use cases, price lines, etc. So I really think back in school, there's just too much, there's just too much value given to that Madman era in terms of the pitch, even in marketing advertising. I mean, I could make a fantastic pitch, but there's got to be substance data behind it, right? I just think sometimes it's just too biased with that one slick presentation. There's too much emphasis on that. And you're right. I think especially in tech businesses, more often than not, I find that the core founder or founding team just tend to be, and I'm not stereotyping, but just tend to be guys or girls who are focused on the product, on the use case, and may not be good orators, right? Maybe they'll hire the orators for business development, marketing later. And it's kind of good to see. But in the same way, maybe it'll be great for everyone here to just understand, even me as an investor is just keen to understand what's inside that black box of Hatcher Plus. You don't have to tell us all the secrets, but what are some parameters that you think, because obviously, right, the reason it interested me is you're not just an investor, you're a founder turned investor. You've done angels, you've done VC deals. Having seen all of that from different lenses, how do you prioritize the different data points which eventually come out as a Hatcher score?
Yeah, that's a great question. So one of the things we do as angels and VC investors is we're constantly looking for founders that are creating an efficiency in some way. If you can create a banana smoothie faster and more flavorful, we're going to invest in you. if you create a mathematical algorithm that does a better job of making your car battery last longer, we'll invest in you. So I think most of venture investing could be summed up as investing behind a new way to move something faster or better or cheaper or what have you. We're doing the same thing at Hatcher. What we're doing though is we're shining a light on the venture industry, and we're saying, okay, the venture industry itself has so many inefficiencies, ranging from how deals get sourced, to how they get studied, to how the diligence gets performed, to the legals. And each one of these things can be quite costly. Like if you just look at the legals, for example, Y Combinator has done us all such a huge favor with the SafeDoc, because that used to be a 3-month process, and now it's a 3-day process. So I think there's so many ways that efficiencies can be created. What we've really focused on is is 2 areas: is the front end deal sourcing area, and how you basically sort through everything that's coming in through your inbox as a VC. And what we've focused on there is, okay, first of all, you need to know yourself. Like, what do I want to invest in? Do I want to invest in marketing communications technologies, or do I want to invest in alternative protein? Do I want to invest in autonomous vehicle technology? So you need to know what your thematic is, and once you know that, that becomes part of your mandate as an investor. You've got a buy-side mandate where you says, I want to go out there and invest in autonomous vehicles. So what we do in that context, if we know that that an accelerator is focused on medical devices, we will define a set of metrics for them that enable them to look at 1,000 inbound applications and figure out very quickly what are the 100 that they should focus on. Now, the huge benefit there is that a lot of the people that work with accelerators, the mentors, the judges, and other people, a lot of them are forced, unfortunately, to plow through 1,000 of these business plans to get to that 100 now. And so if you can just take 900 of those and say, look, it's just not a fit for this accelerator, and do what we do and send it to the accelerator that is a fit, then everyone benefits from that. The accelerator that's focused on medical devices only gets medical devices looking for $100,000 to $150,000 within 250 miles of Nashville, Tennessee, that are pre-revenue, and maybe have a patent pending or whatever else the mandate says. So what we're able to do then is do a much better job of the efficiencies that are happening within that first step that they would then take, which is interviewing the guy. So now they don't have to look at 1,000 business plans. They can look at 100. Of that 100, they can probably fairly quickly to figure out, maybe these are the 30 or 40 guys we're going to do Zoom calls with. And from that, we're going to pick out 10 companies for the cohort. So that's on the front end. On the back end, we had a wonderful experience the other day with a corporate VC out of Europe, where we used our deal scouting technology, which is AI powered, and they were looking for vaping technology, and they said, look, we're very interested in what you have in that area. So we actually went on and we searched for this in our database, and we found a number of hits. And the guy said, oh, this is really remarkable. I said, yeah, it's pretty fast, isn't it? He said, no, it's not the speed. He says, the fact that we just spent 6 months looking for those top 2 companies and we just invested in them. So that's an efficiency as well, in that they spent 6 months, we spent 6 seconds searching our database. And so another level of efficiency. So the other thing is, when you look at really boring areas like audit, reporting, all of these things internally just suck up so much time at VCs, and there's so many people doing very boring manual work. And so what we're trying to do is work with people like PwC and First Degree, our partners, to figure out just better, more automated ways to do things so we can focus on the interesting, sexy stuff.
Nice. I love the element of just, I guess, efficiency, speed, and access to these deals. And I guess a couple of questions there, right? I mean, as an angel, I think, when I did that one deal alongside a VC, it opened my eyes to 4 things, and which started making me question the way I was doing my angel deals. One was, of course, the quality of the company, right? I think angels generally, just because of quantum or just by definition, you're doing very, very early stage. My preference is post-revenue. Some obviously do it pre-revenue as well. So one is quality of company. Secondly, of course, any VC-like organization or accelerator has the resources, capacity, capability to kind of do a thorough due diligence. Next was just the terms. I mean, for an angel investor, till I stumbled upon the SAFE document. Yeah. I mean, in terms of term sheets, agreements, etc. That's a difficult. And even when I got the template, I realized one thing I've learned through that experience is nothing sacrosanct, right? The VC had the upper hand. They could. I'm not saying they were arm twisting. All I'm saying is, from an investor perspective, they got a very, very good deal. And the fourth one, and I think that's what my question is when I was having a chat with them, I realized when they kind of actually invest in a company after X number of months of due diligence, is they have charted out paths of, okay, if this is how the trajectory goes, we'll speak to company A for an exit. They've kind of charted a broad exit plan, right, so to speak, right? So my two questions, are having that experience myself, is A, at your end, how do you take care of the input problem? How do you expand that? What are the sources that you guys, because, to your vaping example, I mean, unless your flow into the bucket is good, you don't have the right kind of deals. The other is, what about exit? I think a lot of angels, at least I've seen, speak only about entries. Oh, I got this deal, I put this money. But at the limited time or the limited quantum of shares that one has, what's your perspective on how could angels or how could Hatcher influence the exit portion of it?
Let's talk about the exit first. Well, actually, the input's very easy. We just partner with the very best accelerators and seed stage and pre-seed guys we can find. And increasingly now we're starting to get interest from partnerships with later stage guys, which is super fun. So our diligence there really just involves understanding what their selection ratio is. We like our partners to select at roughly a 1 in 100 business plans ratio, because we've found that's a good quality threshold. We like to understand their idea of what terms should be going in. We like them to be able to move fast, because one of the big dangers at the moment in angel investing or any investing is that there's a massive compression that's happening. You just mentioned the 3-month window. It's probably a 3-day window for a hot deal in the Valley these days. You got to get a term sheet to that guy pretty quickly. So that's going to become 3 hours before we know it, within the next 5 years, at which point you have to have a very systematic approach to the front end, and you have to have very good partners that are also capable of figuring out very quickly what's going on, and very good systems. The exit thing, I think, is quite fascinating, because I think it's quite misunderstood. There's a piece of Norwegian research where they studied where tech companies exit and why they exit. And what I took away from this, in a very simplistic sort of reading of it, was basically there's 3 phases where people exit. If you and I create a company together, there's a chance that we'll create some just ridiculously good technology, and it'll have a patent, and Pfizer will buy us for $250 million, in year 3 or 4, because the patent is just so incredibly valuable. And look, Pfizer's now going to make billions of dollars off that purchase. So that's sort of a technology only exit. And then there's the sort of revenue exit that happens a few years after that, maybe year 6 or 7. And what they're doing there is they're saying, oh, Happy Market has got awesome revenues going on. And so a large company's taking money out of treasury, buying you guys, and then putting revenue back into the company. It happens all the time, perfectly legal. But that's essentially what they're doing. They've got a bunch of cash in treasury and they want to turn it into revenue. So they go buy someone that's good revenue. They're generally not too worried about profits. Why? Because they've already got profits, or they wouldn't have the money in treasury. And they know that your technology in their new expanded distribution network is going to be awesome. So that's the next thing. And then, of course, the next one's the IPO that's happening around year 10 or year 12, which is a profit-based multiple generally. And so that's how I'd sum up the 3 possibilities of exits without going further detail: technology sale, revenue sale, profit sale, in those 3 kind of broad sort of timeframes.
That's a great classification. I didn't think of it that way. And coming back to your points about profit, right? So most obviously early stage, whether it's angel or VC, obviously either they don't make profits or they choose not to, depends on the situation. But how does your platform cater for that? I love businesses, traditional businesses, could be jewelry, could be furniture, which is generating tons of cash. But obviously they're not classified as startups and scalable startups and all of that. But I have a lot of respect for businesses that's actually generating real money, right? Does your platform is that a merit or a demerit that, man, you're not, you're generating cash, that's not a good thing?
I think one thing that founders need to understand is that venture money can be a proxy for not just profit, but for revenue. If you want to really grow your company fast, you might want to do a Facebook or a Google and just have a totally free service that just goes out there friction free and just scoops up as many users as it can before you start monetizing. So I think the freemium model, as it's popularly called, is a good model that has the right kind of thinking behind it, as long as you manage to transition into monetizing. But to your point about profits, I hate to see profits in a venture-backed company, because you always figure that if this company is growing at 4x a year, maybe they could grow at 5x if they didn't hoard the profits. And so at a certain point, if you're Apple or Microsoft, there's not a whole lot you can do. It's just money coming in the door, and it's so large that it becomes very difficult to do anything with it except make movies, perhaps. But it's interesting, isn't it? We tend to focus on revenue growth as a proxy, but as a proxy for revenue growth, I'm just as happy to look at user growth or usage growth, because I think there's some wonderful companies out there that are just building an amazing beginning. Yeah. Look at WhatsApp and Instagram. These companies created amazing technology, created incredible usage, and still sold for $16 billion. So it's not just about revenue. It's certainly not about profit. It's about going out there and creating massive momentum in some form of measurable metric.
Got that. That's awesome. And, you've obviously done deals across the region. Like, one thing that I find is, every time I speak to someone in the Valley or someone in Europe, I guess that from one lens, it appears so that, the risk appetite is much higher. Like you said, in 3 days, just a PowerPoint deck. There's a couple of friends who said, look, just based on a SaaS idea, they were able to raise capital at a cap of 10, 12 million bucks without just PowerPoint, right? Do you think that that's just the nature of the game, or do you think that's a bit imprudent? Because, on the other side, even at the VC level of late, I've been reading that Tiger has been doing deals every 48 hours, which clearly means there is no IC. Unless the IC is automated, right?
Well, our IC is largely automated, so I think that's definitely a trend. But look, to your point, I think we're going to see a lot more of that. But I have to say, the Americans have been doing this for a lot longer than the rest of us. Right. And so the way that they approach venture capital is generally quite a bit more mature, because they're just able to move faster. They've got more things, more analogs that they can think about on a deal, more experience in doing it, particularly for later stage deals. That said, I think the rest of us are catching up pretty darn fast. And so and I would make one other point before I think we need to cut a break for questions in a second. But one point I would make is that I think a very interesting thing that's just happened for angels and investors in general is COVID has created a situation where the regulators of pharma products, bioscience products, and fintech products have suddenly realized that they need to cut their approval times from 5 years to 2 years to 1 year to 5 months. And that's having a profound effect. I have a fintech company in the Middle East that's now getting approval for other countries at a much rapid clip than it would have a year ago or 2 years ago. And you can see that the concern that we would have all had around a business plan around pharma or medical devices or what have you, we may not have that concern any longer, because the approval process may be a lot quicker than it was before. So I predict the next 5 to 10 years in venture are going to be really pretty amazing. In terms of not just the deal flow that we see, but the growth of value across the board now will even bring in people like bioscience and pharma guys, and that's super exciting.
Yeah, and from my perspective, really excited to kind of see how you guys at Hatcher kind of automated, bring data to throw light as an additional data point to either angels, accelerators, or VCs. Because to me, there's no harm, right? I may have my own judgment criteria, but if there is a signal that tells me, hey, look, here are the pros, cons, or point certain red flags. And I think fundamentally also, to my earlier point, helps me manage the process. Yeah. I think there is, emails and WhatsApps can't be the answer, right? To kind of manage it efficiently at a portfolio level. So, yeah,
maybe for 2 or 3 companies, they're the answer, but not for 200 or 2,000.
And then if that's the case, then it kind of defeats the purpose of building a portfolio, right? Then it isn't really scalable. So I think it's amazing what you guys are doing with VC as a service technology, because yeah, it's fragmented. It's hard to kind of figure out what's the differentiator because there's just so much capital out there, whether be it family offices, accelerators, what have you. And I think if there is a smart way to kind of channelize that capital or just put some intelligence behind that, I think it would make life easy for a lot of people.
Completely agree. Well, should we take some questions?
Sure.
Amit, do we have any questions the people have sent in?
Yes, we do, John. Thanks, Prantik, John. Quite entertaining and interesting. Not a typical webinar, not bored yet.
Good.
Otherwise, fatigue is clearly setting in. And given the questions, I think these people have been alive clearly and listening intently. So I'll combine two questions, and I don't know which one of you wants to take this. So the question is, Hatcher Plus, how do you, sorry, John, I think you'll have to take this. Hatcher Plus, how do you compete with Crunchbase and Traction? And the second question, which I'll dovetail into this, is what are the opportunities for structured data rooms for due diligence to quicken the investment process?
Sorry, what was the second part of the question?
What are the opportunities for structured data rooms for due diligence to quicken the investment process?
Okay, let me answer the second question first. So what we do is we aggregate when when a deal comes in through one of the 300 or so groups that use our platform, we aggregate as much data as we can around that deal. We do video interviews, we do transcripts of that. If it's in a different language than English, we translate everything back. We pull in all the documentation as part of the application process so that we gather all the documents, we gather the video interviews, we gather all of the form data that comes in. Then we go out, we've got about 10 data vendors that we use, and we go out and see what they have, including Crunchbase and PitchBook and what have you, that can aggregate more data into that mix. And then we go out through Dan's API. We call it Dan's API because he's the data scientist that leads the team there. And so we go out through that API and then we do all the scoring and figuring out. All that gets put in very structured places within the data room. So everything's in a place where you can find it pretty easily. With respect to how whether we're competition, we don't compete at all with Crunchbase or PitchBook for a couple of reasons, and Traction. For a couple of reasons, we're quite a bit earlier than any of those guys. They tend to focus more later stage. I think Traction does an excellent job for CVCs, for people looking to look for deals. We have an AI-powered deal scouting engine that operates, that forms a similar function, but in a different way. In terms of Crunchbase and PitchBook, they're more static databases, I would say, but again, focus more on later stage investors. Excellent research tools to use, but what we have is more of a sort of living, breathing, investment platform. It's a very different kind of technology that we're building.
Thanks, John. Couple of questions more. I think one is, which is doing the rounds, especially given the fact that Coinbase got listed at $85 odd billion.
Yeah.
So the question is, what is your view on investing in crypto platforms? Any emerging companies in Southeast Asia, or are regulations still unclear or risky for companies to start up in this area?
Prantik, do you want to take that one?
Well, my answer is very simple. I honestly haven't invested a dime in crypto. There's a bit of FOMO. There's a bit of, just like you have a friend, I have a friend who invested when crypto was probably at about 9 or 10, 10K. So I don't like meeting him at all. But no, I haven't, to be very honest, still trying to figure out how that system works. I haven't had the time or the interest, to be honest, to kind of figure that out. So really not in the best position to comment. All I know is I know a bunch of people who have made decent amount of Bitcoins and decent amount of returns, at least on paper. So something's working.
Yeah, and I would say similarly, I think it's fundamentally amazing. I'm most interested to see what happens when the Chinese launch their digital currency. I think that's going to be a real game changer. I'm looking forward to seeing how that gets picked up. We don't do any crypto investments with our fund. There's some problematic stuff as a fund. Investing in crypto you can still trip up with the regulators and with your banking partners. So you have to be a bit careful about what you choose to invest in there. And it's just worth keeping in mind as an angel, for any angels that are watching this right now, to just check with before you enter the water there, but look, I think it's been a fundamentally amazing ride the last year or so. Let's hope it continues.
We have two more questions. The next question is basically stating that has AI evolved to an extent that it can make investment decisions? John, I think you want to take that one.
Yeah, so someone asked Dan, my partner. So Dan's background, Dan has been working in AI since 1993, ran a company called Retrieval Technologies that worked for pretty much every major content provider in the US. And then he went and helped Tom Evans at Bankrate build a company from 30 million to 570 million a year in revenue, using some very AI-based technologies, business intelligence technologies to match lenders and borrowers. Just did an amazing job of building up business. So he's my partner now. Dan was asked that question, and I don't know of anyone that knows more about AI than Dan and Winnie, one of our advisors. Dan was asked the question recently, and he said Dan doesn't exaggerate, he doesn't underestimate, he just basically calls it as it is. He thinks it's about a 5-year window to get to a point where you could actually trust the AI to make an investment decision. Right now, what we tell our partners who are using our scoring system is, look, this is a junior analyst at the table that's giving you some useful information. You're free to ignore it. It could be wrong, it could be right. But we will know within the next 3 to 4 years, we'll be able to compare human decision-making and AI decision-making. So I think around the year 2024, 2025, when Gardner says 75% of VCs will be using AI to make decisions, we will, by that time, have figured out useful ways that we can use, or that we can let our VC partners use AI in that context.
Thanks, John. Prantik, I think the last one is something which is directed towards you. From the time, I think you mentioned 2019, the question goes, you started investing as a venture investor. What have been your biggest mistakes and the lessons that you learned out of them?
Yeah, good one. I think my biggest lesson is the fact that I think just spending time on a couple of things. One is, I think something that John alluded to earlier is just don't take every friendly proposal too seriously. I think it's important, to keep friendship. And I think with friendship, it's just that, think of it independently. Obviously at an early stage, backing the founder is critical. So one of my portfolio companies, for example, very unfortunate. There was 3 friends who kind of came together. One of them, who's my friend, he quit to join, do this full time. And to me, that's a basic criteria. In fact, that's a learning that I think after that experience, I would want every founder to be full time. There is no half time in this, right? But of course, it's easier said than done. And it just so happened that the other 2 guys who were there half their time, just one fine day, one weekend, unfortunately, both of them, for 2 separate reasons, said, we're not in it. And that just got the guy so demotivated that the company derailed, right? So I think just getting full-time commitment in terms of time, have they put in their own money? I think that's critical. That's one learning. The other is, I think there's a lot of noise and rightfully a lot of chat about product market fit. But I think more and more when I think about it, especially at early stage, I think I'm quite fascinated about the whole thesis around how critical or large is the market size for the problem at hand. So one problem could be very, very critical to me, but maybe the market's not large enough, or the addressable market is not large enough. So I think I'm spending a bit more time on that. Then the second is more than product market fit at an early stage. I'm finding the whole thesis of founder product fit or founder problem fit, right? Assuming I have a great problem to solve in the world of insurance, but am I the right founder or the right founding team to address this? I think it's important to question because, could be passion, conviction, your pedigree, your experience, so many things matter. So I think product market fit, sure. But I think before that, I look at how committed is the founding team in terms of time, effort, money. Second is the founder product fit or the founder problem fit.
I think we have time for just one more question, and it is any interesting companies, I think it's directed to both of you, any interesting companies that you decided not to invest and then became hugely successful? Why did you decide not to invest? What is the underlying reason?
We'll have to have one other question so we can end on a positive. But I'll tell my story very quickly first. We were offered 5% of a ride-sharing company in 2017 that was focused on Eastern Europe. for a very small amount of money through a friend in Paris. And we had run out of money in our first fund, so we would have had to club the deal. But two of the guys, one was getting married, another guy was starting a business, I was starting Hatcher Plus, so it wasn't really great timing for us, so we passed on the deal. That investment today would be worth $38 million on a $500,000 investment. So that was a bit of a sad miss, but it's going to happen. This is the problem. Probabilistically, by the way, when we looked at the deal, we just thought there's no way he's going to be able to go into Paris and outdo the Paris taxi unions. It's just not going to happen. He did exactly that and did a fantastic job as a founder. So that's the other lesson, I think, is never say never. Sometimes these founders find their way around some really tough opponents and just do a cracking job of creating value by creating a minor miracle along the way, which is what he did. Prantik, what's your, do you have one?
Well, it's still early days, but there are two. And I think, I mean, I don't have the data point, but I think I may have missed the boat on those two. Probably I would be a sad man. And but I mean, I always wish well for founders. Doesn't matter whether I missed it or not. But because I don't do B2C, there is a large B2C entity in India in the quasi pharma field, in the Ayurvedic field. So generally, I don't do B2C. Again, medicine is something that, well, my wife's a doctor, but something that I don't understand. But I feel something tells me, I don't have the data points, but something tells me just based on what I've been seeing, reading, that I could have considered that. The other is a pre-IPO opportunity, which I think probably a bit of slowness on my side and a bit of bad luck. So this is probably, I don't know, sometime mid last year, I had the good opportunity of, had I moved quicker, I would have gotten Robinhood at 13 and a half.
Right.
And yeah, that never came back. So I am sure I'll regret it sometime, and my Christmas wouldn't be that fun.
Well, hopefully the rest of our portfolios will make up for those minor missteps along the way. But for any angel watching this, it's going to happen.
Yeah, it's gonna.
There's some great stories out there about people that said that Airbnb thing, no one's ever going to rent out their spare room to a stranger. No one's ever going to have a stranger in the backseat of their car. It's not going to happen. So even the big guys, in fact, both of those, or at least one of those stories came out of Union Square Ventures, which of course is, which refused to invest in Airbnb based on they just didn't see it. But of course they did, they picked up Coinbase. So I think that's made up for that, that problem.
Yeah, you just got to keep going. There is that 1 in 300 unicorn somewhere, John.
1 in 100. It's
sorry. Okay, thank God. 1 in 100. Okay.
1 in 100.
Thanks.
Hey, look, it's so great to be able to talk with you like this. Let's do this again, because I think it's fun. Hopefully, it's helpful for people listening to this. If anyone's listening and they'd like to engage with either Prantik or myself and have a fireside chat about their own experience, bring it on. We'll see if we can make this a series.
Yeah, as long as you don't tell us about the unicorn that you found and we missed, it's all good. But thank you, John. Thanks, Amit, Darren. This has been good fun. I think just a good casual chat, and I'm really excited to see just the way you guys are bringing, data tech into the world of venture investing at an early stage. I think just the kind of research, data points, very, very exciting. So again, thank you for having me on board and for this conversation.
Thank you for your support. Thanks, Prantik.
Thank you. Have a good week.
Cheers.